Okay, let's pull back the curtain on the global economy for a minute and look at the capital markets, the engine that powers pretty much everything. There's this incredible technology on the table that promises a complete top to bottom revolution. But as we're about to see, that revolution, well, it's heading some serious turbulence.
Here's a question for you, and it's one that reveals this giant, frankly bizarre inefficiency at the very heart of modern finance. You can tap your phone and a coffee is yours in seconds. But when you buy a share of a company, something that's purely digital, the actual transfer of ownership can take up to 2 whole days. So what on earth is happening in that 2-day gap?
Well, it's this whole three-step dance. First, on the day of the trade, we'll call it day T, the deal is made. But it's not actually done. Next, it goes into this clearing phase, where a whole backstage crew of middlemen, custodians, and clearinghouses have to verify everything. And only then, 2 days later, does the final settlement actually happen. Every single one of these steps adds time, complexity, and, a whole lot of risk.
And all that complexity, it comes with a price tag, a really big one. Industry research suggests that just by streamlining this, let's be honest, outdated system, financial firms could save up to $12 billion every single year. That's a huge incentive to find a better way. And it's money that could, in theory, find its way back to investors like you and me.
And that better way has a name: Distributed Ledger Technology, or DLT for short. This is the tech that promises to take that entire 2-day journey and just collapse it into a single, instant, unified event.
So how does it actually work? Well, think about it like this. The old system is like one person holding the master spreadsheet for everyone. The bank, the clearinghouse, you just have to trust that they have it right. With DLT, it's totally different. Everyone involved in the network gets an identical, cryptographically sealed copy of that spreadsheet. So the trust isn't in one company anymore. It's baked right into the technology of the network itself.
And the ultimate prize, the holy grail for finance, is something called atomic settlement, or T+0. This is the magic state where the trade, the clearing, and the settlement all happen in the exact same instant. That 2-day window of uncertainty where things could go wrong, poof, it just vanishes. The risk that the person on the other side of your trade might default before it settles, it's basically gone.
But hey, instant settlement is only half the story. DLT has this other incredible superpower, and it's called tokenization. This is the idea that you can take real-world assets, we're talking buildings, fine art, private equity, you name it, and turn them into digital tokens that can be traded instantly on that very same ledger.
And this is the perfect way to picture it. Imagine a $10 million office building. Right now, you can't just sell a window or the lobby. But by tokenizing it, you could transform that building into, say, 100,000 digital shares or tokens. And just like that, a massive, illiquid asset becomes divisible, it becomes easily tradable, opening up investment to a whole new world of people.
So you've got instant settlement and the ability to trade pieces of almost anything. The promise is absolutely immense. But now we have to turn the page. We have to look at reality, where this incredibly powerful technology has run headfirst into the messy, complex world of our existing financial system.
I love this quote because it just cuts right to the heart of the problem. DLT and blockchain are fantastic at preserving a record, making it permanent and unchangeable. But what if the information you put into that permanent record was wrong to begin with?
And that's the absolute critical challenge here. DLT secures the database, but it doesn't secure the data itself. If someone enters a fraudulent transaction or just types in the wrong number, the technology doesn't magically fix it. Nope, it just makes that error permanent and incredibly hard to undo. You've probably heard the phrase garbage in, garbage out. Well, for finance, that's a multi-billion-dollar problem.
This brings us to the real-world lessons being learned by the big players on the front lines. And we're going to start with one of the most dramatic and, frankly, cautionary tales in all of modern finance.
Okay, so down in Australia, the National Stock Exchange, the ASX, decided to go all in. They weren't just testing the waters, they decided to completely replace their entire 25-year-old clearing and settlement system, a system called CHESS, with a brand new one built on DLT. This was the definition of a rip and replace strategy, but on a national scale. And after years of work and millions of lines of code, it failed. The project was paused, which is a nice way of saying it was shelved, forcing the ASX to write off a staggering 250 million Australian dollars. Now, the failure wasn't necessarily because DLT is bad, but it was a brutal lesson in just how risky it is to try and rebuild critical national infrastructure from scratch all at once.
But here's the thing, not everyone took Australia's super risky rip and replace path. As you can see here, two other major strategies have emerged around the world, one in the US and one in Switzerland, and they give us a glimpse into a much more careful way of doing things.
So, over in the US, the main clearinghouse, the DTCC, is being way more cautious. With their Project Ion, they built a DLT settlement system that runs alongside their current one. The old system is still the official book of record, but the new one is being tested in the real world, with real trades without risking the entire US stock market. It's like having a safety net.
And this is no small-time experiment. Project Ion is already processing over 100,000 transactions every single day. It's their way of vetting the technology at scale, getting feedback from the big banks, and working out the kinks with regulators, all while that old, reliable system keeps humming along in the background. Then you've got the Swiss approach with the SIX Digital Exchange, or SDX. They did something completely different. Instead of replacing or running in parallel, they basically built a brand new, fully regulated digital exchange and depository from scratch on a single, integrated DLT platform. This greenfield strategy shows what's possible when the technology and the regulations are designed to work together right from day one. So, where does this leave us? What does it all mean for the future of finance? Well, from these massive global experiments, one huge failure, one cautious success, and one clean slate innovation, four really key lessons have emerged for anyone trying to build this new future. First, and this is the big one from Australia, avoid the Big Bang approach. Go for incremental, parallel rollouts. It's just safer. Second, learn from Switzerland and work with regulators from the very beginning. Third, the whole industry needs to agree on common standards so we don't just end up building a bunch of new, incompatible digital islands. And finally, and this is maybe the most important, you have to obsess over governing the data that goes onto the ledger, because once it's there for good. Which brings us to the big final question. The technology, DLT, it clearly has revolutionary potential. But the actual path to getting it adopted is proving to be slow, it's complex, and it is incredibly risky. So the question isn't just whether this is a revolution or an upgrade, it's whether a perfectly logical, elegant technology can ever truly conquer the messy, complex, and deeply human system of global finance. And right now, that answer is still being written.